in retirement, one of the biggest liabilities that we find for a lot of individuals going into retirement is taxes. And I know everyone wants to pay less taxes, but if we look at our country and some things that are going on, I want to talk a little bit about the likelihood. Are taxes going to go down or are they going to go up?
In the future?
Yeah. Can you spend a little time talking about maybe the history of taxes?
Sure, yeah. Before we can talk about the future, it makes sense to talk about the past. And, if you follow us here on the show, we've talked about it in the past. We existed a long time as a country without any federal income tax.
Yeah.
It wasn't until 1913 that we actually started paying federal income taxes.
Mm-hmm.
So we got along a really long time without any income taxes.
Mm-hmm.
And it's interesting, if you go back to 1912 when they were voting on this, Congress, basically what they said was we had some debt left over from one of our wars and they wanted to get it paid off. So they said that they wanted to have a temporary income. It was going to go away.
Just for a little while.
We're going to pay off the war debt and we're going to go away. So it's going to be a temporary income tax, and the top federal tax bracket would never be greater than 5%. That was going to be the highest. For the highest income earners, they would be paying 5%. So obviously we know that they didn't keep their word back then, just like politicians might not keep their word today. But if you fast forward to today, obviously we're in a higher income tax bracket than they ever promised us. But historically speaking, really, if you go look at the history of taxes all the way back to 1913, today we're in one of the lowest income tax environments we've ever seen. Mm-hmm. The top federal bracket has been as high for the highest income earners, but it's been as high as 94%. Yeah. And it actually, through the 50s and 60s, the top federal bracket spent an entire decade at 90% or above. And again, obviously, I'm talking about the highest income earners, but if the highest bracket's been that high, the other marginal brackets have been much higher as well.
You know, on that topic, I was reading a story about Ronald Reagan, and when he used to be an actor out in California, he would only shoot one movie a year.
Right.
Because if he shot two, he would actually make less money because of taxes.
Right.
So, yeah, I mean, that totally makes sense.
Yeah, just go shoot a movie and take the rest of the year off because you're just working for the government after that.
Yeah.
So
I think that's why he went into politics, is because of that
I think so. I think I read the same thing.
Yeah.
So, well, Jordan, what do you think? You're probably the youngest individual here on the couch with this. Do you think in the future that taxes are going to be higher or lower than what they are right now?
Oh, Matt, it makes sense that the taxes are probably going to have to be higher in the future. I mean, if we look at all of the debt that we're accumulating, our deficit, I was actually reading somewhere about a week ago that they were saying that the average taxpayer has to pay about $1 million just to cover the cost of the debt if we were to resolve all of it right now. And it just seems likely that in the future we'll probably have to pay more taxes.
Right. Well, obviously, if you take a look at the debt clock, everybody's probably seen that website. We'll show it here today. It's 19 trillion, soon to be $20 trillion, and we're still running some budget deficits. So at some point, you don't necessarily have to pay it all back, but at some point you have to start paying some of it back. So I think the likelihood that tax rates will go higher in the future versus where we are right now are probably pretty good. And where that gets concerning is that a lot of individuals that are out there, I know they're putting money into things like 401ks, 403bs, IRAs, and they're taking a tax deduction on those dollars right now, and they're hoping that when they retire in the future that they'll be retiring into a lower income tax bracket, right? That's always the goal. And we see right now, even with tax rates being about as low as they've ever been, that really isn't the case. No. And I think that you could probably make a pretty strong argument that in the future, tax rates will be higher than where we are right now, regardless of who controls the White House or Congress, moving forward. I think tax rates are probably going to have to go up for everybody. If you take a look at the current debt situation, you have the unfunded liabilities, there's just not enough revenue coming into the government to cover everything that we've promised. So one of the things I know that I talk a lot with my clients when I meet with them is we need to find ways to start to transition as much money as we can now. We can't wait until tax rates go up, it'll be too late, but transition as much money as we can now into tax-free options and tax-free accounts.
While the taxes are still relatively low.
Right.
And while you know what they are. So I think that's important as well, is to know so you can plan. Because if you don't know where taxes are going in the future, if you think you need $3,000 a month or $4,000, you don't know what you're really going to need pre-tax.
Right.
So I think it is very important to start transitioning, like you said, over to tax-free.
And for a retiree, really their tax burden is pretty much their number one expense.
That's right.
Their number one expense. Maybe followed closely by medical expenses, but for most individuals, it's how much they're paying in tax is the most important factor. So Jordan, what are some different tax-free options individuals should maybe consider right now before tax rates go higher?
There's a few different options. A really good option could be a Roth IRA. I know not everybody qualifies for that, but a Roth IRA is great. Start to transition those monies into tax-free. Another option too are municipal bonds. But again, like we talk a lot about with interest rates right now being at historic or all-time lows or very close to it, the rates on those are maybe somewhere between about 2 to 3% per year. I don't know if that's anything to get excited about.
Right.
Maybe for a high net worth individual or a high income earner, 2 to 3% could be attractive. Those are kind of two of the other options.
Okay. Yeah, so the Roth IRA is great if you qualify for it, but unfortunately, income limitations, not everybody can use it. But if you can use it, it's something that we like a lot.
Yeah.
Obviously, you're limited to how much you can contribute to it, so you've got to look at some other alternatives, maybe municipals, but right now, like you said, interest rates are a little too low. Anything else that you're talking to individuals about?
Yeah, there's some non-qualified deferred comp plans that you can build for yourself. There's several strategies that you can build if you know now that you're trying to save taxes in the future. So as long as you put some things into place and you're using the right tools, there's definitely some strategies you can use to transition to tax.
Well, I think one of the most beneficial things we can do for individuals and viewers watching right now is we can do an analysis on your situation. So rather than waiting before tax rates go higher in the future, like they most likely will, you can take advantage of the low tax environment that we're in currently and try and make sure that as we move forward, regardless of what happens with tax rates, you're able to pull that money out in a tax efficient manner. So if you take a look at it, if we go out through the 100-plus year history of the stock market, there's been a lot of good times to have been an investor as well as a lot of bad times to have been an investor. Okay, today let's talk about the history of the stock market. Now, most people don't realize this, but the stock market does run in certain predictable cycles. And although we cannot predict the day that something might happen, we can certainly predict the cycle or the trend that we are in. So what I want to do with you here this morning is take a little bit of time to share with you about some information about some very long-term cycles that we've seen during our nation's history. Now, during these long-term periods I'm about to cover with you, there are a lot of smaller subcycles that happen along the way. I know we don't have enough time to go in that amount of detail with you here today. What I want to try and do is kind of share with you from a high-level view what's happened in the past. And then, of course, we'll spend a little bit of time here today talking about what's going on currently. So if you take a look at it, if we go out through the 100-plus year history of the stock market, there's been a lot of good times to have been an investor as well as a lot of bad times to have been an investor. So the first period I want to talk with you about is going to be the years 1930 to the year 1948. Now, during this time period, individuals really struggled, especially if they had a lot of money invested in individual stocks. Chances are if we put money in the market in 1930, chances are it was 1948 before you got your money back. So we would obviously have to say that this time period was a bad time period to have been an investor. Again, chances are if you put money in the market in 1930, you went basically 18 years, little to no growth. Obviously, we now know this time period as the Great Depression. Now, the next cycle or time period is 1948 to 1966. Now, during this time period, we had won the war. We came home, we celebrated, we manufactured basically everything here in the United States of America. I know it might not be true today, but it was back then. And all these types of things were good for the economy and investors. So during this time period, it was definitely a good time to have been an investor. Now, that time period was followed by the years 1966 to the year 1982. Now, this is an interesting period because during this time period, we had concerns over rising inflation. We had unstable interest rates. There was a lot of political unrest. There was a lot of political fighting. We had absolutely out of control oil and gas prices. And probably the biggest issue is the fact that we were involved in a very unpopular war that we really didn't have any way of paying for other than just printing more money and going further into debt. Now, occasionally when I talk about that, individuals will think, well, Matt, at least a few of these things sound familiar. I think you may have skipped ahead. It sounds like you're talking about today. Well, I didn't skip ahead. What I'm talking about is 1966 to 1982. This is what was happening. And obviously, we now know that this was a bad time period to have been an investor. Once again, chances are, let's say you were to go out in the year 1966 and put $1 in the stock market and came back 18 years later in 1982, the account was probably worth right at about $1. So we had 16 years, absolutely no growth for most investors. So let me pause on that for just a moment. Let's think about somebody that, I don't know, maybe it's the year 1966 or maybe 1968, 1970, something like that. They planned on going into retirement and living off the investment earnings of their portfolio. think about it, there weren't any investment earnings on their portfolio for about 16 years. There's a very good chance that those individuals had to either go back to work to bring in more revenue, or what's more likely is that they probably had a pretty dramatic reduction in their standard of living. So obviously a bad time to have been an investor. Now that was followed by the years 1982 to the year 2000. So obviously we know at this point that was a great time to have been an investor. The stock market was up, it was way up, greatest bull market we've ever seen. And that would of course bring us to the year 2000 to today. Now, depending on when you're watching this show, you know, for the year 2000 to today, maybe we're up a little bit, maybe we're down a little bit, but if history is any indicator, it would tell us that we're going to probably have several more years of volatility to go through before we hopefully break out of this particular pattern and start to move forward at a consistent basis. So if you take a look at it, the reason why I always like to cover this type of a subject with individuals is I firmly believe that those that don't know history are bound to repeat it. So if we go back and take a look at what history teaches us, if we had a market that cycled down and then up, it was down and then up, more than likely the next time period, which is right now that we're in today, potentially could be down. Really depends. We have to wait till we get to the end, maybe year 2016, or possibly maybe in the year 2018 before we break out of this particular pattern. Now, after the break, I want you to stay tuned because I'm going to go over some information that talks about why minimizing this type of volatility is crucially important for anybody that is hoping to have a secure and successful retirement. A loss is going to hurt you a lot more than a gain is going to help you. And the reason why is because when we take a loss on our portfolio, if it's tied to the stock market, if the market were to go through some sort of a correction, the average amount of time that it takes to recover is 7 years. Okay, welcome back. I know right before the break we were talking a little bit about the history of the stock market, and I was showing you how we've had some pretty prolonged periods of time where we've seen a lot of volatility. The reason why I like to cover that information is this. If you're soon to be retired or already retired, I think it's really important that you minimize risk in your portfolio and the amount of volatility that you can have. I say it all the time, when you're closer and into retirement, a loss is going to hurt you a lot more than a gain is going to help you. And the reason why is because when we take a loss on our portfolio, if it's tied to the stock market, if the market were to go through some sort of a correction, the average amount of time that it takes to recover is 7 years. That's the average recovery time. We've seen it take as long as 18 years for individuals just to break even. And the reason why that is because it's very difficult to offset losses. A lot of times people will think, if I have a portfolio, and let's just say, to keep it simple, let's say that we have $100,000 in some sort of an investment or retirement account. If the stock market were to lose 50% one year, and then let's say grow by 50% the next year, a lot of times individuals will think that they're back to even. And that's not the case. You know, if we have $100,000 and it drops in value to $50,000 after 1 year, and then let's say that the next year the stock market rallies and recovers, and then we're up by 50%, we're not back to even, right? We're just sitting there at $75,000. What it actually will take in order to recover from a 50% drop is a 100% gain. And that's why it can take as many as 7 years on average to recover from stock market drops. So let's take a look at it another way. I really think that consistency counts when you're planning your retirement. So let's take a look at two different investment scenarios. And I've covered this before in the past, and a lot of times individuals get a little confused when I start out. You know, you can actually have an investment that's averaging 10% in returns. It can actually outperform an investment that's averaging 25% in returns. And a lot of times individuals think, well, how is that possible? If we go back to our example of a $100,000 investment, let's say that the first year we win big. So we're going to take a whole lot of risk. We don't mind volatility, so we're trying to hit a home run. And let's say the first year it works, and we grow by 100%. So obviously, we're up to $200,000. Now, let's say that the next year we have a year kind of like we're talking about here, and the stock market suffers a correction. Let's say that the next year we lose 50% on the investment. So obviously, we're back to $100,000. Now let's take a look at another scenario. Let's say that we have an investor that wants to minimize risk, volatility, they don't want to ride a roller coaster, they're looking for consistency. So if we have $100,000 in this investment, and let's say that we're going to be a little more conservative, and let's assume hypothetically we could get a 10% return in a year where the market is up big. And that means that we're going to have $110,000 after the first year. Now, a lot of times if this individual were to talk to that individual, they might not be very happy with their returns. What you have to understand though is that retirement planning is definitely, it's not a sprint, it's a marathon that we're running. The long-term performance is what's important. So let's take a look at the second year, and let's say that again, we just kind of, rather than hitting a home run, we're just trying to shoot for singles and doubles. The next year we get a 10% return. So obviously this account is worth $121,000 at the end of the 2-year period. What's interesting is if you take a look at it, the average return on this investment is 25%. That's the average return over the 2-year period. The average return on this investment, of course, is just 10%. So this is how consistency can really help you with your investment portfolio. It's not these large increases and drops that helps you have a successful retirement. It's making sure that you stay consistent and trying to have a safety net during the down years. And again, if history is any indicator, it would tell us that we're going to have several more years of volatility to go through before we hopefully break out of this particular pattern. So again, if you're retired or soon to be retired, I think it's really important that you at least get a second opinion and make sure that you're not carrying too much risk, because as you move closer and into retirement, we don't want to run the risk of losing 30 or 40 or possibly as much as 50% or more in your portfolio like it's happened in the past.
So if you're putting money into an account on a monthly basis and you're taking advantage of that market volatility, that over time you're using what's called dollar cost averaging. So that's a great place to accumulate your portfolio and start trying to save as much as you can for retirement. I want to talk a little bit about the different investment manufacturers or the different investment worlds that are competing for your hard-earned dollar. Now, they all have a place in your portfolio. You just got to know when to use them and then when to kind of stay away from them. So first I want to talk about the bank. Everybody has a bank account, some type of savings or checking, and that's great. What you want to do is you want to keep somewhere between 6 and 12 months of your expenses always in liquidity. So you always want that in your checking or savings, or money market would be okay as well. The next investment world is going to be the brokerage. So this would be any type of stocks, bonds, mutual funds, ETFs, any type of security that's going up and down with the market. That's great to have in your portfolio, especially in the accumulation phase of your life. So if you're putting money into an account on a monthly basis and you're taking advantage of that market volatility, that over time you're using what's called dollar cost averaging. So that's a great place to accumulate your portfolio and start trying to save as much as you can for retirement. Now, once you move into retirement, then you're going to want to use what the insurance world would have to offer. So this could be things like fixed annuities. This could be things like indexed annuities. Now, I wouldn't, however, consider a variable annuity one of the strategies that I would use in retirement, but it is actually in the insurance umbrella. It would fall more in the brokerage or security types of investments. Now, where the insurance is going to be the best fit for your portfolio is to produce that guaranteed income strategy, or somewhere that you're wanting to put some money to have the potential to grow in value, but have protection from downside risk. So the brokerage world, again, is going to be where your life's curveballs. So once you've moved into retirement, you have your insurance strategy or your annuity strategy set up to produce that guarantee. Well, now you can use your brokerage accounts for life's curveballs. Now, this wouldn't be when the kids need to borrow money, because that never happens. But if it did, this is where that type of investment where you would use that. Now, where you would use your checking and savings account, this is to just pay your ongoing expenses, your bills that are going on each and every month. So it's important to know what investments that you need and where you need to be diversified to have the right type of portfolio for retirement planning. Well, that wraps it up for the week. Thank you for tuning in.